Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture. Financial Instrument, IFRS 9. The objective is to allow users of the account to evaluate the significance of the financial instrument for the entity's financial position and performance. Also, the nature and extent of risk arising from the financial statement. And lastly, the management of the risk arising from the financial statement. We're going to first take a look at what the financial instruments are. Now, it is a contract that gives rise to a financial asset of one entity and a financial liability or an equity instrument to another entity. So, if you look at the illustration here, when entity A purchases shares from entity B, it is a financial asset to entity A and a liability to entity B. When A purchases a debt from B, it is an asset to A and a liability to B. Then lastly, when A sells goods to B, so it's a liability to B and an asset to A. Okay. So let's first look at what a financial asset is in the definition given earlier. A financial asset is a cash or an equity instrument of another entity or a contractual right to either one, to receive cash or another financial asset from another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are favorable to the entity. So examples of which is a cash, stocks, in other words, shares, bonds, or loans. So unlike land, property, commodities, and other tangible physical assets, financial assets do not necessarily have an inherent physical worth or even a physical form. So rather, their value reflects the factors of supply and demand in the marketplace in which they trade, as well as the degree of risk that they carry. So financial assets, in as much as non-physical, their value is derived from a contractual claim on an underlying asset. So we look at the initial measurements of financial assets. Recognize a financial asset initially at fair value, including transaction cost, unless it is classified as fair value through profit and loss. Okay, so when we talk about initial measurements, it is the first time that the business enters into the contractual agreement that leads to the financial assets. Now look at the subsequent measurement. So financial assets are classified into those that are measured under amortized cost and those that are measured at fair value. So where assets are measured at fair value, gains and losses are either recognized entirely in the profit or loss account, that is fair value through profit or loss, or fair value through other comprehensive income. Now let's take a look at the various financial assets that we have. So when an entity invests in a debt instrument, maybe they give out a loan to another entity, what happens is that the debt instrument that meets the following two conditions must be measured at amortized cost, net of any written down impairment, unless the asset is designated at fair value through profit or loss under the fair value option. First, the business model test. So here, the objective of the entity's business model is to hold the financial asset to collect the contractual cash flows rather than to sell the instrument prior to its contractual maturity to realize its fair value changes. The second test is a cash flow characteristic test. So the contractual terms of the financial asset give rise on specific dates to cash flows that are solely payment of principal and interest on the principal amount outstanding. If the objective of the business model is to collect cash receipts and sell the financial asset instead of holding it to its maturity period, then it has to be recognized under fair value through other comprehensive income. We move ahead to look at equity instruments. So all equity instruments are to be measured at fair value in the statement of financial position, where the fair value changes recognized in profit or loss. Now, if an equity investment or instrument is not held for trading purposes, that is, it is supposed to be held and collect contractual cash flows to its maturity period, an entity can make an election at initial recognition to measure it at fair value through other comprehensive income, with gain or loss recognized in the other comprehensive income, and only dividend income recognized in the profit or loss. Let's now look at the derecognition of financial assets. So financial assets are derecognized when sold off, with gains or loss on disposal recognized through profit or loss. Okay, so gains or losses previously recognized through other comprehensive income are transferred to retained earnings through the statement of changes in equity. So an asset is supposed to be derecognized when it is transferred. So an asset is transferred if the entity either transfers the contractual right to receive cash flows, or the entity has retained the contractual right to receive the cash flows from the asset, but has assumed a contractual obligation to pass those cash flows on. Let's now test our understanding. Now we have to explain how each of the above financial assets will be accounted for in the financial statement. 1. Ed bought 500,000 shares in a listed entity on 1st November 2020. Now each share costs $5 to purchase and a fee of $0.1 per share paid as a commission. Now the fair value of each share at 31st December 2020 was $4. So here we elect to classify the investment in shares as fair value through profit or loss. Therefore, it is initially recognized at $2.5 million. That is the 500,000 shares multiplied by its value of $5 on the statement of financial position as an asset. The transaction cost of $50,000, that is the 500,000 shares times the $0.1, which is to be charged immediately to the profit or loss account. Now, at the reporting date, the shares are to be remeasured to their fair value of $2 million on the statement of financial position. That is the 500,000 times the $4. Now, the resulting loss of $500,000, which is the difference between the 2.5 million and the 2 million, is recognized through profit or loss account. Second example, Ed bought 1 million shares in a listed entity on 1st March 2020 for $5 million, incurring transaction cost of $30,000. Ed acquired the shares as part of a long-term strategy to realize the gains in the future. Now, the fair value of the shares was $6.2 million at 31st December. The shares were subsequently sold for $6.5 million on 31st December 2021. So since the asset is intended to be held onto, it is initially classified as fair value through other comprehensive income. Therefore, the investment will be recognized in the statement of financial position as an asset at $5,030,000. That is the share value inclusive of the transaction cost. Now, at the reporting date, we are to remeasure to fair value, that is the $6.2 million, in the statement of financial position, with a gain of $1,170,000. That is the difference between the 6.2 million fair value at the reporting date, less the initial recognition of $5,030,000 to be recognized in the other comprehensive income. Upon sale, a gain of $300,000, that is the proceeds less the fair value amount. This will be charged to the profit or loss account, and then again initially recognized in the other comprehensive income at $1,170,000, moved to retain earnings through statement of changes in equity as a reserve transfer. So lastly, Ed bought 100,000 debentures at a 2% discount at par value of $100. The coupon rate attached to the debentures is 4%. The effective rate of interest on the debenture is 5%. The investment in debt is classified as amortized cost, as there are contractual coupon interest receipts each year, and I intend to hold the assets until all the cash has been collected. So the business model and the cash flow characteristic tests have both been passed. So the investment in debt is initially measured at $980,000. That is the 1 million discounted by 2%. Okay, on the statement of financial position. Now that we are done with the financial assets, we move on to financial liabilities. So this is a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial assets or financial liability with another entity under conditions that are potentially unfavorable to the entity. So for financial liabilities, initial measurements will be to recognize at fair value less of transaction cost unless classified as fair value through profit or loss. Subsequently, if the liabilities are supposed to be held for trading, then it is supposed to be valued at fair value through profit or loss, and all other financial liabilities are measured at amortized cost unless the fair value option is applied. So a financial liability should be removed from the balance sheet when and only when the contractual obligation is either discharged or cancelled or expires. So where there has been an exchange between an existing borrower and lender with substantially different terms, or there has been a substantial adjustment to the terms of an existing financial liability, this transaction qualifies for the original financial liability to be derecognized and the recognition of the new financial liability. So a gain or loss from the derecognition of the original financial liability is recognized in a profit or loss. So let's test our understanding on financial liabilities. So Norma issues 50,000 redeemable debentures at their $100 par value, incurring issue cost of $100,000. Now the debentures are redeemable at a 5% premium in 5 years' time and carry a coupon rate of 2%. The effective rate on a debenture is 4%. Now we have to calculate the amount to be shown in the statement of financial position and statement of profit or loss for each of the 5 years of the debenture. So for the solution, on the statement of profit or loss account, you're going to have a finance cost of $196 for year 1, $199.84 for year 2, $203.83 for year 3, $207.99 for year 4, and $212.33 for year 5. We come to the statement of financial position and we have these figures here. Let's move straight to look at the mechanism that brought about these figures. When we come to year 1, the opening is the 5 million, which is the 500,000 times the $100 par value, less the issuing cost, giving 4.9 million. So the interest, which is the effective rate of 4%, so 4% on the 4.9 gives $196, which is recognized in year 1 for the statement of profit or loss account. When we come to the repayment, which is the coupon rate, that is what the entity actually pays. So this is charged on the original amount, which is the 5 million, giving $100,000 here. The resulting figure is $4,996,000. So this is the figure that is captured in the statement of financial position for year 1. The same figure will be the opening for year 2. We multiply the 4% on it, gives us $199.84, recorded in the profit or loss for year 2. Charge the same 2%, results in $5,095,084, recorded in year 2 in the statement of financial position. Becomes the opening for year 3. Multiplies 4% on it, gives $203,083. Charged to the income statement or profit or loss account for year 3. Pays out $100,000. Results in a figure of $5,199,067, recorded in the financial position for year 3. Becomes the opening for year 4. Charged 4% on it, $207,099, recorded in the profit or loss account for year 4. Pays out $100,000. Leads to $5,307,066, which is recorded in the statement of financial position for year 4. We bring it to year 5 as an opening. We multiply the 4% on it. Gives us $212,031. We charge it to the income statement for year 5 as a finance cost. The maturity is in 5 years' time. So you're not going to pay out just the coupon rate, but pay the principal in addition. So it's going to give $5,518,000.97. So the balance for year 5 is going to be 0. Let's quickly move to convertible debentures. This is a long-term debt that can be converted into equity after a specified period of time. Now, it is a combination of equity and liability and is accounted for using the split equity accounting method. The liability element is calculated by discounting back the maximum possible amount of cash that will be repaid, assuming the conversion doesn't take place. So the discount rate to be used is the interest rate on similar debt without any conversion option. Now, the equity element is the difference between the proceeds on issue and the initial liability element. So when you discount the figure to today's terms, the value that you get, you less it from the proceeds on the convertible debenture, and the difference is charged as an equity. Now, the liability element is subsequently measured at amortized cost, using the interest rate on similar debts without the conversion option as an effective rate, like we did for the financial liability, the amortized cost. The equity element is not subsequently changed. Okay, we don't use the amortized cost to adjust it annually until the conversion is done to equity. So let's test our understanding. So Alice issued 1,004% convertible debentures at the start of the accounting year at par value of $100 million. The effective interest on similar debt without a conversion option is 6%. Now, we have to explain how Alice should account for the convertible debenture in its financial statement for each of the 3 years. So when we come to the solution, the legal liability is recognized at the present value of the future cash flows, discounted at the rate of interest on similar debt without a conversion option. So this is going to give a figure of $94,690,000. So for year 1, we have the cash flow, that is the effective interest rate of 4% multiplied on the 100 million, giving 4 million. Then there's the counting factor with the 6%, which is the interest on similar loans without the conversion option. So to get this figure, it's going to be 1 over 100 plus 6%, which is 1.06 raised to the power 1, because we are discounting from year 1 to now, which is going to give a discounting factor of 0.943. So the present value for the 4 million after year 1 is $3,770,000. When we come to year 2, the cash flow is still 4 million. The discounting factor is now going to be 0.890. To get that, it is 1 divided by, that is 100 plus 6, which is 1.06 raised to the power 2. So when we multiply the 4 million to the discounting factor, we are getting $3,560,000. Year 3, it is going to be the cash flow, that is the interest, plus the amount to be redeemed, that is 100 million, which is $104 million. Discounting factor is going to be 1 divided by 1.06 raised to the power 3, giving $87,360,000. So the total will now be $94,690,000, which is recorded in the statement of financial position as a debt. Now, when you take the 100 million and you less the value for the liability out of it, it's going to result in 5.3 million, which is charged to equity, also in the statement of financial position. Let's take a look at the disclosures. So the significance of the financial instruments for the entity's financial position and performance should be disclosed. Also, the nature and extent of risk arising from the financial instruments, and also the management of the risk arising from the financial instruments. Also, the nature and extent of financial risk should also be disclosed in the financial statement. So financial risk arising from the use of financial instruments can be defined as a credit risk, a liquidity risk, and a market risk. So disclosures with regards to this risk need to be both qualitative and quantitative, as in the amount from the risk must be stated and the effects on the financial statement must also be disclosed. So when we come to the breakdown of the financial risk, we take credit risk first. So this is the risk that a lender may not receive the owed principal and interest that he or she has invested in. This results in the interruption of cash flows and increased cost for collection. Now, liquidity risk is the risk that an individual investor or business or financial institution cannot emit its short-term debt, that is, its current assets cannot suffice its current liability. The last risk is market risk. Now, this is the risk of losses on financial investment caused by adverse price movement. Reclassification. So this is required between fair value through profit or loss, fair value through other comprehensive income, and the amortized cost, if and only if the entity's business model objective for its financial assets changes. So its previous model assessment will no longer apply. Okay. So if the reclassification is appropriate, it must be done prospectively from the reclassification date, which is defined as the first day of the first reporting period following the change in the business model. So an entity does not restate its previously recognized gains, losses, or interest. This is where we bring our discussion to an end on financial instruments. If there's any feedback or comments for us, feel free to drop them in the comment section below, and it will be gladly attended to. Don't forget to subscribe, as we always say. Click on the notification bell by it, like and share. Till we come to you again by way of tutorials on the go. Take care of yourself and stay blessed. Poker.